the House passed the Frank-Dodd bill this week. The Senate starts debate next week. One key piece of the legislation focuses on derivatives. The current bill would require almost 90% of trades to clear through a third-party clearinghouse. If that happens, Roger Liddell, CEO of Europe's and the world's largest clearinghouse, LCH.Clearnet Group, will see more business for sure. Roger is with us now. Roger, welcome to the newsroom. Glad to have you with us.
Good to be here, thank you.
You've got to be the one happy person. I guess you're not the only happy person, but one of the happiest people out there. I mean, if the legislation goes through as proposed, you're going to gain a lot more business.
Yes, indeed. And obviously that's good for us. We're very happy about that. We don't deny it. But actually, we also think this is actually good for the markets and will benefit a lot of people. So we think this is a good step forward.
All right. You mentioned that it's going to be good for the markets. I know you're a managing director. You were in charge of global operations at Goldman Sachs. You know the nature of the beast. Some of these firms can't be happy about this. They're showing resistance, and I'm just wondering why. Because in theory, with the clearinghouse, they get less risk, I would say, and more volatility. So why all the resistance? Is it just about pricing information?
No, I don't think so. You know, people tell me there's resistance. I don't see much evidence, frankly, because most of our customers, who in fact are our shareholders, are really working with us to try and develop clearing systems for other asset classes and really pushing hard to bring clients in. So I think actually they're behind it. I think there is some genuine concern, however, at the potential cost of additional margin taking out of the system with clients. So I think there are some balanced concerns, but overall I think there's a general widespread belief that clearing is good for the system, transparency is going to be good for everybody, and taking risk out of the system has to be good for the markets.
So when you say, you know, worried about sort of paying on the margin, that would be to companies such as yourself, clearinghouses.
It would, but I mean the issue that some of the banks are concerned about is with some of their clients having to find the margin, and that just takes more capital. So that's the cost of clearing, but I think it's a worthwhile cost because of the safety that it brings to the system. So
would Goldman Sachs and some of the others just be clearing like crazy right now? Is that what you think they're doing before this becomes mandatory?
They're all the major banks are actively out marketing this to their customers, trying to build a clearing business out of it, frankly. But also keen to reduce the credit risk that they have with their clients and with each other.
I want to ask you, I mean, Germany has recently banned these so-called naked credit default swaps. France is proposing it. Is it possible for each country to go it alone, or is this a case of you really do need unified action? Well,
that's a really good question, because countries can go it alone, and there are some signs of that at the moment. But there is a big risk attached to that, and that means a business could move to different locations. So I think there is also a genuine, genuine desire now on behalf of the major regulators and policymakers to try and work as far as possible in sync with each other. But that's a tough challenge with individual governments having their own agendas.
Do you think it's likely at all, if you had to handicap a scale of 1 to 10, that Europe could be on a unified system, a unified set of rules, and that Europe, the US, and Asia could be on the same set of rules?
I think Europe is likely to be on the same set of rules. I think Europe and the US will be slightly different, but I think they'll be working hard together to try and harmonise, frankly.
Why is one party, or let's just talk about interest rate swaps, because that's about 40% of your business, and overall we want to say you basically have about 50% of all the OTC derivatives business right now. You spoke earlier saying, look, it's really our shareholders who are going to gain the most when we increase business, but if you have about 50% of this $600 trillion market right now, how much are you going to have when this legislation passes?
Well, we don't know. Obviously more, and also it's a growing market. The market is growing at a pretty dramatic rate. But we would expect certainly double-digit increases over the next couple of years.
All right. Now, interest rate swaps, as we just mentioned, a huge part, the biggest part of that OTC derivatives market. What about foreign exchange? I mean, this is a highly liquid market. Does it not need to be regulated in the same way that we're considering derivatives?
Well, that's one of the areas in which Europe and the US are diverging, because all the indications from Europe are that they will be including more of the foreign exchange derivative products and forwards in their legislation. This is a service that we're really working on at the moment. We're keen to develop it, so we will be offering clearing in foreign exchange options and forwards.
All right, Roger, thanks so much for stopping in on your way back to London today.